Good afternoon and welcome to Stock Market Today, sponsored by Interactive Brokers. On the show today, we'll be looking at Twilio, the Trade Desk, and Chipotle Mexican Grill. But first, let's take a look at the major market indexes. I'm Justin Nielsen, and I'm along here with Ed Carson today. And Allie's on vacation, so it's going to be us holding down the fort for a little bit, along with Ken Shreve. So it was an interesting day today. It looked not too bad on the indexes, especially as we're closing here. S&P 500 down about 16 hundredths. The composite down 44 basis points. So not even a half a percentage point on the NASDAQ. Dow Jones actually closing positive, up 0.1%.
Yeah, I mean, the NASDAQ sold off more during the day, but even then it was down 1%, and we're at record highs. So it was hard to get too excited, especially as the market came back a little bit. But that's why, we always say you want to look at the major market averages and the leading stocks. And while some leading stocks did quite well, and we'll talk about some of those, there was also software names in particular were hard hit. I mean, they've been doing very well. So that's an issue. I mean, it's also just an issue about the catalysts going forward. I mean, we have a lot of news this week, so a lot of earnings. They've already been driving the market higher. The Fed rate cut is coming on Wednesday, but will they say more? How much? And what will they suggest going forward? Will they? Because the market's pricing in 2 or 3 rate cuts, and maybe the Fed will say, you know what, the economy's doing pretty well. One is just fine. China trade talks, I don't think anybody's expecting a blow up, but nobody's expecting really good news either. So that's one thing, is that we're at record highs, and it's not clear that some of these
Do they just kick the can down the road again? That's what they've been doing.
Yeah, and so it may be that the market sort of could go sideways. Again, market will do what it wants to, but it's sort of an interesting week of a lot of big news that may not really move the market.
Okay, so down less than 0.5% on the composite is where we ended, but software, as you mentioned, that was the really big. If you were in software, you felt like, oh my gosh, the sky is falling. At the beginning of the day. So let's first go ahead and start talking about Twilio. Now, if you're a long-term holder of this looks like, hey, maybe it's a regular pullback to the 50-day moving average line. What's your take on Twilio here? Yeah,
well, Twilio actually formed a flat base as of Friday. It almost broke out, sort of early. It came down to the 50-day line, which is positive, but it's also, it was sharp action. This was very much the whole sector. A lot of stocks fell to their 50-day line or further. I mean, some of them came back to it. It's something to watch out for. They have earnings coming up. So maybe this is one last shakeout, but it's also just another reason why you don't want to buy before a breakout, before earnings. I mean, this is a double reason not to.
Right, and we're starting to get a little bit later stage on this one too, so even initiating after earnings, that might be a little bit problematic. It's third stage? So you're still okay, but it's getting up there.
Yeah, a lot of these breakouts, it's not like in January, February, where it's like first stage or second stage bases. There's a little more likely to fail. Yeah. And they may work, but
it doesn't mean they're going to, but the likelihood goes up. Yeah. So let's go ahead and switch our attention over to another, not quite software, but software-ish, the Trade Desk.
Yeah, Trade Desk is a digital ad platform, so you got to figure software's probably involved somewhere in there. Trade Desk had broken out really nicely on Friday, and then gave it all back. It actually closed right around the buy point, probably found support there. But this is why you don't buy extended. It actually got extended as of Friday, a Friday's close.
Yeah, your feelings right now really depend on where you bought this. If you bought it at the buy point, okay, I'm flat. If you bought it extended at the highs of Friday, you're down quite a bit.
Yeah, actually at the lows today, it was down 8% from Friday's high, so it would have been an automatic sell rule. And again, you're like, oh, I want a hot stock, and people often say CAN SLIM is momentum trading, but no, it's momentum right when the momentum starts. It's not just momentum any old place.
Yeah. So now this brings up another point. So both of these stocks got hit pretty hard. So sometimes it's actually not a bad idea to make sure you're not just in the leading groups, but that you're spread out a little bit amongst the leading stocks in some different groups, right?
Yeah, I mean, that's one of the things as we talk about, don't be diversified in a general broad sense of good and bad stocks, but among that core group of those really elite stocks, maybe they shouldn't all be software or shouldn't all be chips. Something, you want to have that so you don't get that sky is falling sense. If you had 5 top software stocks today and we're on margin, oh boy.
And you might have been, I was diversified because I was in software security and software enterprise. Yeah, that's not quite the diversity that we're talking about.
No, not exactly.
So let's go ahead and talk about something that is kind of outside of the software realm, and that's Chipotle Mexican Grill.
Yeah, and Chipotle, it cleared a buy point last week on its earnings. Today, Goldman Sachs said, hey, we're initiating with a 1,000 price target, somewhere like over a 20% gain from where it was on Friday. The stock is now extended But again, this is just acting well after earnings, and this is actually a good reason of why we sometimes argue for a call option strategy. Maybe you could discuss how we did this on Leaderboard.
Yeah. So actually on Leaderboard we had Chipotle on this. I think from on Leaderboard from February through May, I believe, and we had a good gain on it, and then we put it on more recently before earnings, a few weeks. It didn't quite have much traction yet, and so we were going into the earnings report without any cushion, and that's not what we like to do. So what we did was we transferred that stock position to an option position. It was trading around $23.65, the premium at that time for a $732.50 strike price that expired on July 26th, the last Friday. And so by switching it to that option, we capped our risk, even if, turned out that, E. coli was hitting again and other foodborne illnesses, it didn't matter. We were going to be protected to a limited risk, but we also got to participate if it did go up, and that's exactly what happened. So as this was trading at $7.79 after earnings, we had the $732.50 strike price locked in, and that's where we actually exercised the shares, and now we have a position that we're up on as it's crossing 800.
Yeah, and so there's a lot of stocks right now. A lot of them may have broken out or just nudging above it with a lot of earnings this week, and so that's something to keep in mind. If you have a stock with a very small cushion or a little bit on a loss, you definitely want to be thinking of an options play if you're going to hold it through earnings.
Now, one other thing, just while we're on the topic, a lot of people get a little afraid of something that's trading at $800, thinking, oh my gosh, I can only afford to buy like a few shares or whatever. What's your take on high-price stocks?
Well, it's how much you're investing. It's the dollar amount. If you can buy 10 shares of Chipotle, rather than 100 shares of some $80 stock, it's really the same thing.
Right.
It's your percentage gains and losses off of that investment. That's what matters.
Yeah. Do you have 4 5s or one $20 bill? Kind of thing. Okay. So a few other things that people should know about is we have coming up, it is Shark Week on MarketSmith. And so for a lot of people, they might be taking a look at a webinar that we have going on tomorrow. So if you haven't registered for that already, please do so. It is going to be at 11 a.m. Pacific time, 2 p.m. Eastern time. And Arusha is going to be joined with Charles Harris and Mike Webster. So you and I have worked with these guys for almost 2 decades now. They've been doing portfolio management for our sister company, in-house portfolio management, and so they really know their stuff, and they're going to be talking about how to trade like a market shark.
And these are a couple market sharks.
Yes, exactly. They know what they're doing. They actually came to the portfolio management because they had 1,000% plus years that got the attention of Bill O'Neill. So that's something pretty impressive. And if you haven't already, you should also go ahead and take a look at our social media. We are on Facebook, Twitter, Instagram, YouTube. And if you would like to follow us, you can follow investors.com. You can follow some of the reporters. You have quite the Twitter following with insights on markets as well as life in general, and some funny things that go along with that. But that'll be all for our show today. You'll see Ed and I back here tomorrow, and hopefully we will see you as well. Thanks for watching.